Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we are going to be analyzing Pool Corporation, ticker POOL. This one came in by request down in the comment section of one of my other videos. If you have a request you'd like me to take a look at, put it down in the comments. I will get the ticker on the whiteboard behind me. Eventually I will make a video for you. If it's a stock that's in the S&P 500 like Pool is, I post those on YouTube for free. The rest I post over on Patreon, where I have several different tier levels. There's a free tier, so if you want to make sure you don't miss anything on YouTube, make sure to join the free tier over on Patreon. There's a $5 tier, and that's where I post any requests that are not in the S&P 500, so just any stock. Or you can just ask me about it in the chat room, and sometimes I just respond, and sometimes I make a video. Kind of depends on which stock it is. And then there's a new $25 tier level where every week I will have a stock pick. I just started that last week, so it's off to a good start, and we're going to track those results over the long term, and I also make those investments myself. So if you think what I do here makes a little bit of sense, and you just want some steady ideas, a lot of times on here I'm aiming for really low prices. The idea of the weekly service or the weekly idea is that I just look at the market, and whatever the best deal is that week, that's what I'm going to share using the several different strategies that I use. So there'll be different types of strategies that are used for that, and no stock will be picked more than 4 times. So I'm assuming that these are, since it's every week, that the position sizes are relatively small, about 0.5% of our portfolio. So no one stock would start with or build over more than 2% initial weighting, right? It's 4 times. So there might be some that get overweighted, and there might be some that are underweighted, but there are limits to that. The idea is to look and find the best relative value in the market. So those links will be down in the description if you want to check those out. All right, so let's get into Pool. This is an interesting one, a pretty unique stock. They do basically all sorts of swimming pool related things. They're global, worldwide, and I always like to start by just looking at the historical earnings once I know kind of what they do. Usually I actually look at the earnings first, and that tells me a lot about what I want to know, but this is kind of a unique business, so I thought I'd put what they did out there at the very beginning. Usually what I do is I look at the historical earnings using the fast graph here. So, and that's represented by this dark green area on the fast graph. And the first thing I want to know is, how cyclical are these during like an economic recession, or just are there any unusual patterns, or is anything that jumps out at me? So if we go back to the Great Recession, we can see that they had 3 years where earnings growth declined. Looks like a total decline was maybe 45%-ish, just glancing at it. Peaked at 174, bottom in 2009 at 95 cents a share. This would be right on the borderline of like a deep cyclical. I think if we use basic earnings instead of the adjusted earnings, we definitely see a deep cyclical decline in 2009. But it never went totally negative, right? So I think you can treat this stock as a moderately cyclical business. Definitely economically sensitive. So what that means is, if there's a recession, their earnings growth is not going to continue in a straight line, right? They wouldn't see $1.74 a share again until 2012, right? So it took 6 years to get back to that level that they peaked at in 2006, when we had a housing boom in the US and everybody was buying and building houses for way too much money. So that's definitely cyclicality. I mean, that's a lot of years, you know. So, for example, if you would have bought near this peak in 2006 and held for, what is that, I'll just do 10 years flat. That's a whole decade. So on the fast graph, we can go over here, a full decade. There it is. You only would have gotten a 7% annual return for that decade. And that's because you would have bought it, you know, near the peak of a boom, right? And I would say that that's probably a pretty lucky outcome. And a lot of it would have had to do with the fact we had 0% interest rates from 2009 on or 2008 on. And over time, people were able to finance bigger things like pools or homes with pools and things like that. So if only 5 years later, the stock price was probably still negative, it looks like. So it's good to understand that cyclicality when we think about buying a stock like this so that we don't buy it during one of the peaks. So now when we go to what's happened recently, what we had was another boom in housing and in pools because of COVID and COVID stimulus and another round of 0% interest rates. So tons of stimulus goes in, homes become very popular, people are working from home more instead of going to the office, more people want to move out of the cities and into the suburbs where there's more room for things like pools. And so we kind of all know how that went down. What wouldn't have been exactly how I would have expected it at the beginning of the pandemic. But that is what happened. So we had this huge boom, and these guys, participated in that, and they had huge years of 44% growth, 80% growth, and 20% growth. So they went from $5.83 a share in earnings at the end of 2019 to $18. I mean, more than triple. I mean, it's kind of crazy in 3 years. So that is a true boom. And now what we're seeing is the bust of the boom. So last year earnings fell 28%. This year they're expected to fall 16%. Importantly, this bust from the previous boom actually isn't due to recession. So we haven't had like a real recession yet. And if we do, then we should probably expect these earnings to fall more. And also expect the price to fall more. Although I will say the price has stopped following earnings down, which is a little unusual, but it is what it is. So for me, the question is, at what point does this bust end? What sort of additional risk is there if there is a recession, right? So all those are risk factors for me, and I've basically been avoiding this stock, since 2022. It would have gone right in my boom bust category, and now we're seeing it play out. So if we go to my spreadsheet, we'll see that my notes here are boom bust risk remains. So I removed my buy price back in 2022 on this, even though I still track it and keep an eye on it, because it's really hard to know when you have a bust like this how this all ends, but that it's not going to be good compared to, was it 2000? Yeah, so this is the end of 20, right at the peak here is pretty much when I started warning people about the boom bust, right in January 2022, and I sold a bunch of stocks that had this sort of risk. I didn't sell all of them. There's a couple that I should have sold that I didn't, but I sold most of them. So it's down about 35% off the high. I bet it was down about half. Yeah, I was looking at the lows here, down almost 50% during these low points. So I would say we've had some portion of this bust. Now the price going into the pandemic, which was at a 38 PE, it was not cheap, right? Was $233 a share. If you figure another $50 for inflation since then to kind of get a similar read on how things were in February of 2020, you're looking at we'll call it 285. So right now we're still in the 300s. It looks like we did bottom out right around that level in 2022. So at they bottomed at 278. So right at that, about where you would expect. So that bottoming was about the equivalent of where it was at going into the pandemic, right? Inflation adjusted, because we've had about 20% inflation. So one way to think about that is forgetting what the earnings are doing and that somehow they'll all bottom out eventually and work itself out. The stock is, at that point when it was trading lower, was still trading about, in the upper 30s PE. And importantly, we still haven't had a recession yet. Now we might not have one, right? we might get through all this and not have a recession or anything really particularly bad that happens. And they might do okay. But I think the main thing I want to say is the risk is there's still a lot of downside risk if there's a recession. So I'm not ready to kind of step in and buy it, but I am going to show you the valuation if a person wanted to run one based on where their current earnings are now, which is about $11.04 a share. So that's where I have their earnings. I assume that earnings growth, once it bottoms, can grow about 12%. That's roughly kind of where it was pre-pandemic. It kind of depends on where you want to pick your measurement points. But if we look at what analysts are thinking in the future, they're looking at 10% and then 6%. So they're a little more pessimistic. But if earnings bottom lower than 11, which I think they probably will, then coming off that bottom will usually be a little bit faster growth, right? So if we go back, I don't know what this is going to actually turn out, but I'm thinking I'm going to make my point here. So we bought them in 2009 at 95 cents a share. Then they grew 20%, 21%, 28%, 26%. So the next 3 years, they had plus 20% growth each year. And you could even shorten the fast graph if you want to actually take a look at it. Let's see. And yeah, so during this time period, they actually grew 20% coming out of the Great Recession. All the way up, if we go all the way up to, about 20%. From the bottom of the Great Recession to the beginning of the 20% per year, to the beginning of the pandemic. So my 12% is maybe a little, but they're a bigger company now, right? So they're probably not going to grow quite as much. But the fact that this is higher than what analysts expect means I probably am not going to change it if this $11 turns into $7 next year in earnings or something. So that's my thinking behind that. Now, the number here, let me move my head down since I told everybody I would do that. The number here is the 10-year expected CAGR, earnings CAGR. So this is what you can expect to earn if you own this business. If you earned $11.04 this year and it grew at 12% each year for 10 years, this is the main valuation metric I use for earnings. What this doesn't include is a downturn. So the way to think about this really is once earnings bottom, I think this will be a pretty good metric, and I could even raise that maybe up to like 15% depending on how low the earnings ultimately bottom. I'm not convinced we're at the bottom yet. But I wanted to kind of put some numbers on it for folks if you want an earnings valuation, which are tough to do on these cyclical businesses because the way that I do it, because I think about it as collected earnings over time. And when you have 3 years where earnings are declining, right, you're not getting a steady 12%. You have to have really big growth rates like those 20% growth rates in order to make up for years when it's declining in order to ultimately get to like a 12% average. And that's hard to account for. A lot of people get that wrong with these type of moderately cyclical businesses. So that's my thinking. But I just wanted to put some numbers on it so folks can, dial in on a couple things if they want to try to value it. So the current price is $366 basically, and my buy price which would be when this 10-year CAGR earnings CAGR gets to 8%, would be $166 a share, and the fair value midpoint would be about $220 a share. That would be when this 10-year CAGR is about at 6.5%. So it's overvalued, I would say right now for sure. Pretty much by any, or at least richly valued. So I don't think we've probably seen the bottom unless we really totally avoid like a recession pretty much, or any kind of a downturn. Momentum is basically in the middle right now for these guys. Another way to maybe do this, because if you're trying to get a lower price, is if they have a year that's really bad next year and everything, the bottom just falls out. If you keep an eye on the momentum, try to wait for it to actually turn positive. It's basically kind of leveled off right now, and that's where it stands right now. If we look at the stock price, you can kind of see that that's the case, right? It's basically been trading in the same range for the past 2 years, right? And I don't really see any upside catalyst. If anything, there's more downside risk here than upside catalyst potential. So I think people are maybe just being optimistic that this might be the bottom and that eventually over the next couple of years they'll start growing again. But I mean, look, it's trading at a 32 PE. In order to justify that, they need to be growing at like 20% a year for another 10 years in order for that to be a good buying opportunity. But they're kind of breaking this streak of very steady earnings growth that they experienced leading into the pandemic, which is why you notice the PE expands this whole time. In 2012, the PE was like 23 to 24. By the time we went into the pandemic, it was 38. So the stock price was growing much faster than the actual earnings were growing during that time. And that can only last so long. I mean, there are stocks like Costco where they seem to never end. I think they might be up in the 50s now again. And there are periods where businesses go through that and stocks go through that. But eventually, either they are flat for several years or the multiple pulls back. So I would expect a pullback, but I don't know the timing of that. Okay, I hope that helped everybody kind of how to think about Pool. If you have any questions, put them in the comments. I also have a 25% off Fast Graph discount link down in the description, and I'll see everybody later. Bye.